Welcome to the Allan Small Financial Show. Thank you for taking some time out of your busy day to spend it with us here. I know this time of year, everyone's busy shopping for the holidays or putting the last touches on work projects and events before the end of the year. So I want to thank everyone for tuning in today. I think we have a great show for you today. We have a few topics that I believe are timely, as well as topics that have come up during the course of my last 2 weeks in discussions with clients, with investors. And I thought they'd be really, really good to share these ideas and topics that we were discussing with all of you. Because as always, if someone out there has questions regarding something, that means there are probably many others that have the same types of questions. So I like to bring these ideas and these questions to all of you. And lastly, as I always say, if any of you have any questions, please put them in the chat box on the YouTube channel or Facebook, LinkedIn, wherever you may be watching the show. I'd be happy to answer your questions at the end of the show. And if I don't get to them, I will do my best to answer them the following show in 2 weeks on the 7th. So let's get on with the show and take a look at this week's topics. So this week we have bear market rallies. What is a bear market rally? And a lot of people have been talking negatively of them. I think bear market rallies are actually a good thing. So we'll talk about that. We'll talk about this week, our usual segment, where I discuss what I believe is important for individual investors to consider when they make their investment decisions in the next 1 to 2 weeks. This is cashing out. Some people have been asking me, if we know a recession is coming in 2023, maybe we should cash out of our investments. The old saying, sell in May and go away, is it should be sell in January and go away? We'll discuss. We'll also talk a bit about tax loss selling. What is it? And should we be considering it at this time? Tech layoffs. I talk a lot about technology stocks and how I think they're a really good value over the last few months. And till this day, I still think they're a good value. They've been laying off a lot of people. Is that a bad thing? Should investors be worried? And lastly, I'm going to take the questions from all of you, from all the viewers, whatever questions you may have. I'd be happy to answer them at the end of the show. So bear market rallies, what are they? Well, let's define a bear market. A bear market is when you have the market fall more than 20% from the recent highs. When you have a market that falls greater than 10%, that's actually called a correction. So a bear market rally would be a rally in the stock market or the stock market rising when you are in what we would consider or a time when the markets are down by more than 20%. Now, the reason why a lot of individual investors, analysts, economists, everyone pretty much in general, the reason why they think bear market rallies are a bit of a head fake or something that shouldn't be, or you shouldn't put too much stock in them, is because they tend to happen very quickly. So you see these rallies, market rallies for 1 or 2 days, and then they're usually followed by a decline in the markets, giving back what the rally made and then some. In my opinion, though, I like bear market rallies, even though I would love to see this be the start of a new bull market rally. Bear market rallies are still very powerful. Why? Because if you see the market go up 1,200 points on the Dow, for example, or you see the market rally, the S&P rallying, a few hundred points, the next time you get a sell-off, you will basically give back some of the returns you made, but you won't be in a negative position. So bear market rallies allow us or give us some cushion for when the next fall happens. Also, bear market rallies tend to be the biggest rallies we see, the most sharp increases in the market. And as we know, these increases in the market definitely help us make money over the long term. So whereas many people will say, don't fall a victim of this bear market rally, don't put a lot of faith in the bear market rally. We should, keep a level perspective. I say, yes, we should. However, number one, you never know when this bear market rally could become something longer and more meaningful. And number two, it gives us an opportunity to make back some of the losses that we've incurred. So I don't think anyone out there, investors out there in the month of July of this year, or the month of October of this year, were really upset to see their portfolios jump significantly, even though August was a negative month and September was a really poor month. At least the month of July gave us some reprieve, gave us some gains, so that once we move forward and we see the markets decline again, at least we're not falling further. So if your portfolio jumps up 2, 3, 4%, followed by a decline of 2, 3, 4%, you're back at square one and flat for the year. Versus if you didn't see that bear market rally, or that rally during a bear market, you probably would be down 3, 4, 5% for the year. So bear markets are very important. Don't be, confused or told that these rallies don't mean anything. In my opinion, they actually mean quite a bit. They allow us to make back losses that we've incurred already in the year, and they give us a bit of a cushion should we have losses going forward. So this is the part of the show that I talk about every show, where we discuss what I believe is important for individual investors to consider before you make your investment decisions over the next 1 to 2 weeks. And today we're going to talk about perhaps a topic that we tend to touch on quite often, which is what the Fed is saying, Fed speak, if you will. Today at 2 p.m., the minutes of the last Fed meeting will be released, and it is important. We're also going to touch on asset mix or asset management, portfolio mix. Should you be thinking about bonds today as part of your portfolio? And third, or last but not least, dividend stocks. If everyone's talking about a pullback or a recession in 2023, how are investors going to make money? Well, maybe dividend stocks are the answer. So I want to touch on all those three things. And so we'll start off with the Fed. As I said earlier, the Fed at 2 p.m. will release the minutes of their last meeting. They're going to discuss basically, what they said in that meeting, where they think the economy is right now. And I think it's important for individual investors to understand what they're saying. And I think we have a few quotes by the Fed as well. And what we're noticing is that even though some of the officials in the U.S., as the Federal Reserve is in the U.S., of course, even though they all are saying that they have to continue to raise interest rates, and the Bank of Canada is saying the same thing, they're all starting to talk about slowing down the interest rate increases. So instead of raising interest rates 75 basis points, they're talking about perhaps raising it only 50 basis points, let's say for the month of December. Bank of Canada is talking the same way. And so here you see, pausing is off the table right now. It's not even part of the discussion. What is part of the discussion is slowing the pace of increases. So that was Mary Daly, the San Francisco Fed. And then you have Lyle Brainerd, who is the vice chair, who holds a little more weight. I think it would probably be appropriate soon to move to a slower pace of rate increases. So the stock market likes this. Whenever we hear a Fed official talk about slowing down the pace of increases, the market gets excited and moves to the upside. Now, make no mistake about it, 50 basis point increase is still a big increase. Prior to this year, pretty much the only increase, 25 points. And now we're starting to see 50 or consider 50 basis points as a slowdown in increases. So we've come a long way. I guess in the US, they've increased as much as 75 points. And here in Canada, we actually had one meeting where the Bank of Canada raised a full percentage point. So if we start to go now 50 and eventually 25, that would mean to me and most investors that we're coming closer to the end of this higher interest rate cycle than we are towards the beginning. And I always say higher for longer right now, because these interest rates will probably remain at these levels, what they consider restrictive levels, they meaning the Federal Reserve and Bank of Canada, for some time to come. So don't look for interest rates to be cut anytime soon unless we start to see a deep recession. If Canada and or the US were to go into more of a deeper recession next year, then perhaps the Fed and Bank of Canada may turn to cutting rates. But their credibility is on the line, make no mistake about it. And so if they start cutting next year after raising so much this year, I think a lot of people would question their credibility more so than they're already doing right now. So understanding what the Fed is saying, the Federal Reserve in the US, is probably even more important than what the Bank of Canada is saying to your portfolios at this time. The second point that I wanted to touch on is portfolio or asset mix, asset management. I'm getting a lot of questions talking or asking me about, should we be having or owning more bonds in our portfolios? Bonds today, you could pick up a very short-term bond, less than 3 years, paying in and around 5% interest. Now, keep in mind, when you factor out or take away taxes that you're going to pay on the interest that you earn, if the product is held outside of a registered plan like an RSP or a tax-free savings account, and factoring in inflation in our country here, which is 6.9%, how much of the gains do you have left? Well, the answer is nothing. You actually would still have a negative rate of return. So when people talk to me about asset mix, portfolio mix, how much they should have in bonds versus stocks, it's a discussion we need to have, and is very important because people still have to understand that fixed income right now is still not helping to grow your wealth. It is there to protect your wealth, but not necessarily to grow it. So if you do have money parked in some fixed income right now, it is a part of your portfolio that you know is, for the most part, not going to go down if the stock market goes down, especially if you're buying good quality bonds. And I like to buy, my bonds are all investment grade, as we call it, or A-rated bonds, because those are the ones that have the least chance for default, if you will. So owning bonds, owning good quality bonds, paying 5%, I believe, can become more and more as part of a diversified portfolio, as long as investors understand that that is not the part of their portfolio that's going to give them any growth. At this point in time, with inflation still in and around 7%, it's very difficult to make money on these types of investments. The third topic for this show, for this week, this segment, that I think is important before you make your investment decisions going forward, is one we've talked about, I think, in the past, or I've spoken about many times on TV or on radio about. And these are your dividend stocks, your dividend payers. And I have a chart that clearly shows that if you're invested in dividend paying investments and those dividends are reinvested over time, you clearly will see that your returns are significantly higher. And so when you have an environment, and there's the chart right there, you're looking at growth in price only. So this would be, let's say you owned a stock over the last, it looks like, I'm trying to see the chart, I don't have my glasses on, but over the last 30 years or so. And you see here how much growth you would get. And then the darker line shows you how much growth you would have, or how much gains you would have, if you bought dividend paying investments and had those dividends reinvested. So a substantial difference between the two. And if you do believe, and I do, that we are headed for, or perhaps already in, some sort of mild recession, dividend paying investments are a great idea, because you're getting paid something while you wait for the growth to happen later on down the road. So if you're investing in a name like Enbridge that are paying, 6%, and a little bit more on the Enbridge stock, you're making 6%. You may not see a lot of appreciation in their share price, but you're still making 6%. If those stocks were to rise, let's say, even just 5% for the year, well, that's 11% rate of return for the year, versus someone that maybe just owned a growth stock making 5%. So dividends are a very powerful instrument, and something that I think should be a part of everybody's portfolio if you're looking to grow your wealth over time. Now, last thing I will say about this topic is, I'm not saying, you don't need or you shouldn't own growth investments, because I think you need to own those as well. names that I believe will grow even in a difficult environment, even in a slowing economy. I think you can still find growth names that will grow for you in value, go up and appreciate in value. So if you built a portfolio, if this is for your equity component or your stock component, out of good quality growth names that are undervalued right now, plus adding in some dividend and growth names, so names that can grow in value but also pay a very good dividend, that to me would be a great recipe for success for all of us to grow our portfolios and our wealth, even in a recession or a mild recession, which we may fall into in the first few quarters of next year. According to the Bank of Canada, it is a possibility, but I still think your portfolio can grow. And always keep in mind, the stock market is looking forward, not behind, and the stock market is looking 6 to 12 months ahead. And so even though the economy, in January, when we get into January in the new year, might soften, stock market can still rally because it anticipates better times later on in 2023, which I believe we will see once again. Staying invested versus cashing out your investments. Now, interesting, this topic came to me because it was a question I was asked by an individual investor. And they said, well, if everybody is saying we're going into some sort of at least a mild recession, or definitely a slowdown at the start of 2023 due to higher interest rates and the Fed and the Bank of Canada doing what they're doing, maybe it's time to cash out. Maybe it's time to move some money to the sidelines. And I have a couple of interesting charts that show why that is actually not a good strategy, where cashing out is not a good strategy. And you would see here, I guess the two main columns to look at in this chart are the first or the second column, which shows price return, and then you would show excluding I believe it is the 10 best days, the markets and the difference in returns. And this is over a pretty long period, since 1930, I believe. And you would see here the amount of returns if you just stayed in the market and didn't try and time the market, pull your money out to put it back in at a later. You can see the returns are over 17,000%. But if you missed the top days in that period, whether they're 10, whether they're 15, doesn't matter. But just those few days, you can see a substantial reduction in how much money you would have made over the last bunch of years. Obviously, the total at the bottom of that column, less than 30%, and you can see that a huge difference. And that's how powerful this staying in the market is. And my strategy for all of my clients that may be watching, my strategy. For those of you that aren't clients of mine, I'll tell you a bit about it. And that is all to do with staying in the market, but restructuring your portfolio, trying to move some of the B quality names, change them for some of the A quality names, some of the names that are on sale that I believe are A quality, leaders in their sectors, leaders in their industries, and names that I think will be the first to rebound when the market rebounds and the economy rebounds, and the names that perhaps will provide you a little more defense should the market fall back a little more. So my strategy has always been to stay invested. You never know when those best days are. If you look back in history, I think we have another chart as well, but if you look back in history, the best days for the market tend to come after the worst. So if you're one to sell after a bad day in the market drops significantly. If you were to sell at the end of that day, and then the next day the market rebounds, the Dow goes down 500-600 points, and then the next day it rebounds 1,200 points because someone from the Federal Reserve said something positive, then you're sitting there going, oh my goodness, I just missed one of those, top 10 or 15 best days in the market, which eventually will eat away at my returns over time. So what you want to do is you want to stay invested. Even if you have to move some money around into some better quality names, staying invested has always been, in my opinion, the best way to go. Timing markets has never been the best way to go. And even if you look back this year, had you gotten fed up of the markets after the first half of the year because it was pretty much all negative, and you were to sell out sometime at the end of June and you were to be in cash, well, here you are today. Second half of 2022 has been a positive half to the year. Most investors have actually had positive returns since the end of June or the second half of this year. The stock market in North America has been positive the second half of this year. Right now, you'd be sitting at a point where you were at pretty much low points back at the end of June. And if your money was sitting in cash, you wouldn't have recouped much of that. Whereas had you stay invested, you would have recouped some of those losses. And again, this year, we haven't made back all the losses that we saw in the first half, but we've made back a chunk of it. And hopefully, we'll see more of those losses made back in the last month of the year in December. I think we could end the year off on a positive note, have a bit of Santa Claus rally. So stay invested, even when times are tough. Just move money around to places that you think make sense. And I think that is the way to go rather than pulling your money out of the market. Some of you may have heard that we are approaching or already in tax loss selling season. What's tax loss selling? Well, at the end of every year, we add up all the money that we made, capital gains. So if we sold something, we made money on it, we now have to pay tax on those gains. Well, some of us like to go and take a look at our portfolios and sell something perhaps at a loss that will offset some of the gains. So sell an investment that you lose money on. Let's say you lost $100 on that investment, and then you made, let's say, $200 from selling. So you have a $200 gain and a $100 loss. You pay capital tax on just $100. So there are many people that at this time in the year look to selling some investments, not because they're up a lot, but actually because they could use the tax loss to offset their gains. And if you want to, you can always go in and buy back that same investment 30 days later. If you buy back into that investment that you sold for the loss prior to 30 days, then the tax loss selling strategy does not work. Government does not allow you to buy back in, and you would not be able to write off those losses. One thing I will say about tax loss selling, maybe a bit of a fallacy from people watching today, is that in a year like we've had this past year, where most investors are saying, well, I'm down for the year. There's, some people think that, well, there probably won't be a lot of gains this year because the market's been down, my portfolio's been down. Well, I find when I go through all my clients' portfolios that in years where the markets are down or portfolio is down, that's when you actually have more capital gains, because we're very quick to take a gain when we have it, because the market is so volatile. We're trying to crystallize our gains before they pull back or fall back again. So perhaps in a year that the market is doing well, market's going up, up, and up, you may not want to sell. You may want to hang in there for the ride a little longer on that investment idea versus sell it a little more quickly in a volatile market. So I find that in volatile markets, in negative markets, that investors have more capital gains to look for capital losses to offset versus the other way around. And where the market is very, very well, people seem to think, well, I must have a loss. Not necessarily, because it's usually the case that we want to hold on to these for a longer period of time. So tax loss that you're going to see, or maybe already started to see, can affect the stock market a little bit, because you do have a bunch of investors crystallizing or realizing those losses, and it could cause the market to fall a little bit, dip a little bit at certain times, depending on the investment that is being sold. So look for perhaps a higher than normal volume over the first few weeks of December, next few weeks after the Thanksgiving holiday. And that would just mean to me that it is a number of investors and institutions crystallizing or realizing those tax losses so they can offset them against their gains. Tech layoffs. I've been on this show and as I said earlier, radio show and uh, the Sunday Money show that I do every other Sunday as well, talking about how I believe that tech names like the one you see in front of you, the Amazons, the Microsofts, the Metas, formerly Facebook, make sense at this point in time. A lot of them are down greater than 30%. I know Facebook at one point was down greater than 70%, and people were nervous about buying more or buying into these names. What these have done recently, in my opinion, is begun to right size their business, not downsize. I call it right size. Let's take a name like Amazon. Amazon during COVID times, they needed to get more people to work. They opened up more fulfillment centers. And when COVID started to, taper off this past year, people started to get out and about more often, go to malls again, started to go shopping in person again. Amazon quickly realized that they didn't need as many fulfillment centers. They didn't need as many people working in these buildings. So Amazon has started to downsize, right size their business. We've heard, names like Meta or Facebook cutting 13% of their workforce. Names like Google or Apple talk about how they're having hiring freezes. Hewlett Packard just last night talking about cutting workforce. And I know a lot of people, when you see that headline, oh, Amazon cutting, so many workers, Meta cutting 11,000 workers. I get phone calls saying, how are you buying these stocks or recommending them if they're cutting people? That's bad, isn't it? Well, truth is, it's bad if you're one of the workers being laid off. Unfortunately, it's never a good thing. But if you're a shareholder, it actually is a good thing because they are reducing costs. And a name like Meta or Facebook, that has been the number one problem for their business. They're spending more and more and more money on the metaverse, something that doesn't make them any money as yet. And so they've been racking up a lot of costs. Amazon, same thing. A lot of these tech names have just exploded in terms of how many workers they have, their hiring counts, and now they're having to cut back. And as we know, if you run a business, your biggest cost are the people, right? Salaries. And so cutting these people, cutting the workforce down at your business is definitely a good thing for the long term and for shareholders. And I say it's unfortunate, obviously, because you never want to see anyone lose their jobs. But from an investment standpoint, when Meta announced that they were cutting, I think it was 13,000 workers, 11,000 workers, 13% of their workforce, stock actually rallied from about $85, $90 a share to almost $120 a share. That's how powerful their statement was about cutting costs. So don't look at these tech names as names that are kind of falling off just because they're right-sizing their businesses. These names are fantastic names to own at these low prices. And I still believe, even with the most recent rally in the markets, you can continue to look at these big cap technology names as an opportunity, not something to run away from, but as an opportunity, perhaps to buy more or to get into these names if you're not in them already. Opportunity to make money over the next 6, 12, 18 months down the road. I think anybody that has the stomach to buy these volatile, large technology names, if you can handle the risks involved, I think you will be rewarded in the next 1 to 2 years, even if they continue to right size their business. So now we're at the part of the show where I take some of the questions that I've received throughout the show, as well as I believe I have one question that I didn't get to from last show. And let's start with the question from last show. It says, where do you see the old standby stocks like utilities, banks, telcos, and REITs that retirees count on for steady dividends in this rising rate environment? And so this question came, I think, from YouTube, according to what I see. So this person's asking about, the old value stocks, the utilities, the banks, the telcos. I think an environment, obviously, that we could be in starting in 2023, where we are in somewhat of a slowdown or perhaps a mild recession. As I mentioned earlier, many of the names or the sectors you've mentioned in your question pay dividends. So these are good names to own. They're going to pay you something while you wait for the growth. However, I think you need a blend. You need a blend of some of these names with some of the growth names that like tech stocks, for example, that I mentioned, or other sectors, maybe some other names like pharmaceutical or retail, or other sectors, industrial names, some of the names that, that build, the heavy machinery. John Deere or Deere and Company reported great earnings today. They actually took up their expectations for the remainder of the year and into next year. So I think you still need the growthy names. Perhaps the growthy names are a little bit more sexy than some of the sectors that you've mentioned, but I think a balance of those two things, growth as well as this person puts it, old standby stocks that we've all relied on for so many years. So a balance between the two works really well. Hopefully I can take a couple of more questions. Do you ever have clients set up accounts as gifts for children or grandchildren? What kinds of stocks do they buy for them? I am just thinking of different ideas for holiday gifts. Yeah, the holidays are coming up. I think that's a great idea. Grandchildren or children, what I always say to the grandparents or the parents is, if you are going to buy something for the kids, buy something for them that at least they recognize, something in their lives. You're not going to want to buy shares of a company that they have no idea who they are or what they do. So a lot of clients of mine or investors, they tend to look at perhaps a Disney stock, maybe one of the bank stocks, because the kids always see, the banks driving around the city. Anything that they are familiar with, maybe Amazon, maybe even Microsoft if they're into gaming with Xbox or something along those lines. So good quality names that kids will recognize. I had another client of mine talk about Starbucks because I think it was their son, or I can't remember if it was son or daughter, loved to go to Starbucks and get a drink from Starbucks. They always were at Starbucks, or even owning maybe McDonald's or a Nike as well. So what I would recommend is buying something the kids can watch, can understand, and they can be proud that they own shares of these companies. I'll take one quick one and then one last one here. I keep hearing talk about buying what's on sale right now. How do you determine if a stock is a good deal for your clients? And I guess the way I do it is you got to do your homework on the stock. You have to compare it to its peers, to its competitors. You got to compare it to itself from a historical standpoint. Take a look at how much money they're making, how much money they're spending. We talked about that earlier. Take a look at certain ratios, PE ratio, price to the company's earnings, PEG ratio, price of the stock versus the company's earnings versus its growth rate. These are all different things that we look at when we look at funding. We also may want to take a look at its chart, see if we can glean anything from how the chart of the stock has gone, how it has behaved. So there are a lot of things to look at. It's not so simple when someone recommends a stock or an investment idea, they just close their eyes and pick it. They got to really do your homework. And that's where investment advisors come in, of course. We're here to help create a portfolio for you based on fundamentals, based on technical analysis, based on a whole gamut of information. And that's what we do. So compare that investment to its peers, its competitors. And I think that would give you a pretty good insight as to if you should buy this investment or not. With that, I guess that's the end of the show. I want to thank everyone for watching. Again, we will be back on air again 2 weeks from today. I believe it's December 7th. And until then, I want to wish everyone a great 2 weeks and happy investing.